Michael Pond of Barclays Capital. That firm is one of the 20 broker-dealers that sell Treasury debt. He joins us now from his office in Manhattan. Michael, welcome to InBusiness. You said before the weekend that anything short of $4 trillion wasn't a credible deal for the marketplace. What do you think about what we got today?
That's right. So on Thursday, John Chambers from S&P said $4 trillion would be a good start, and we're far from that $4 trillion number that S&P would like to see. So we're still at a pretty strong risk of a downgrade of U.S. Treasuries, even though it appears that we'll avoid default altogether. So, that to us means a steeper yield curve, and the economic data that's been coming in will support shorter-end Treasuries, pushing yields lower there, even as longer-rated Treasuries or longer-maturity Treasuries can sell off. So, again, the economic data that we got on Friday and, again, this morning from the ISM just reinforces that steepener call.
So since we are below that $4 trillion and there's no stimulus in there, at least at this point, as we understand it, what does this mean to you in terms of the trading environment we're going to see for the U.S. debt?
Well, it means the growth outlook is already pretty soft, and on top of that, we're likely to get an additional fiscal drag in 2012. So that keeps the Fed at bay even longer. There's certainly going to be no talk of an exit strategy anytime soon, and that means it'll be hard-pressed for yields to rise, except at the long end of the curve, where investors might become a bit more concerned that the government might try to inflate its way out of its debt problems, and longer-term inflation expectation can actually pick up, given that inflation has actually been running fairly high recently. So the 3-month average annual rate on core CPI right now is 2.9%. That's a far cry from the 0.6 year-over-year that we got in October. So inflation has turned around, but the Fed cannot react to that. So again, it puts them in a tough position. And the bar is pretty high for QE3, but we're going to likely get increased talk of additional stimulus from the Fed.
Do you expect disruption of bond auctions?
Well, we don't. Again, we expect that, given that we're avoiding default in the near term, today's bill auction, tomorrow's bill auctions, which are very important to concerns over a liquidity crunch, will go fine, and that we'll get to the mid-month refundings, and that those will go fine as well. Without the debt ceiling increase, we would have been pretty concerned about how auctions go. But given that it's the long-term outlook that's concerned, the auctions should go fine this month. Yeah.
But long term, the reason I ask that question is there are those who say that the U.S. has lost credibility here, in that you look at emerging market countries paying almost as little as developed market countries in the credit markets. I mean, is there a credibility hit here?
Sure. I mean, Obama talked last week in one of his speeches that while from an economy standpoint, the U.S. is still solidly AAA, but it's not clear that we have a AAA political system. So it's the willingness that's of the U.S. to pay its debt that will be put into question here, and that means that longer yields should rise, at least relative to shorter yields.
And we're looking at the Treasury 10-year note declining to the lowest level that we've seen since November as we wrap up here. We got to leave it there, Michael. Thank you very much for giving us your insight. Appreciate your time.